Thanks for joining us today. For those who have joined us in the past, welcome. For those who are new, Adam and I are advisors at Withum Wealth. Adam holds the CFP, or Certified Financial Planning Professional accreditation, and I hold the CFP, CFA, and AWMA accreditations. Today, we're going to spend a very brief amount of time walking through just a few slides in our quarterly market update. Adam, you ready to get the show on the road?
Let's jump right in. We've got limited time today, so we're
Limited
going to
time
make the
today.
most of it.
So, Adam, has the Fed conquered inflation? Don't you love when news articles use that terminology? It makes me picture Jerome Powell in a knight's armor, sword held high, standing on top of some sort of mythical beast. Do you think Powell can start suiting up?
It seems that way. I mean, I don't know how much he and the Fed actually did, or said another way, I don't know if inflation would have come down anyways because of supply chains normalizing, or the fact that the Treasury stopped sending out checks to everyone. But they raised rates 550 basis points, and here we are. Inflation's trending on its way to 2%, it seems, and that's their goal. So they've begun cutting rates.
Right. And a resurgence of inflation can still happen. It's not totally out of the picture, but from what we're seeing, everything's pointing to, inflation's probably under control, at least for now.
It seems that way. The last couple of high frequency data points have come out, and rates have come up a little bit on the long end, maybe suggesting that there's going to be a reacceleration of growth, or there are some fears of higher inflation expected in the future. It could just be risks associated with the debt or the deficit. The short end of the yield curve is going to continue coming down as the Fed cuts rates. The long end is going to be a little bit more volatile no matter what happens.
Sure. So let's jump into what's occurred since inflation started to come down. The Fed cut rates. We've been talking a lot in our podcast, Amplified Wealth, about what kind of tailwinds we would expect once the market was more confident that the Fed's going to move rates down. Can you talk a little bit about this?
Yeah. So we wanted to look in the marketplace and determine, was there a moment, or was it a compilation of different data points that it became evident the Fed was winning that battle, conquering that war, that beast of inflation, and going to be switching and pivoting their policy to rate cuts. If you recall, back in the spring, in January, February, March, we had inflation fears picking back up with some hot data points. It was actually the June CPI reading, which was released on July 11th, that we feel was the real turning point. You saw yields come way down. It caused a little bit of a market correction, which we're going to talk about. But there was this momentous shift in the odds and the likelihood that the Federal Reserve is going to cut rates. If not at July, it was going to be at September for sure. Again, this was early July at the time. They did not end up cutting rates at the July 31st meeting, but they did do a two-step, or 50 basis point, 0.5% cut in the September meeting. Maybe they should have gone in July and just done 125 basis point cut at each meeting. But, we can debate that all night long if we want. The point is, this July 11th date in the marketplace is what we wanted to look at, where there was a clear shift in lower rates are going to be in the future. How does that impact different areas and different asset classes?
Right.
So if you want to walk us through what we're looking at here on this chart, we wanted to break down the different sectors, different asset classes, and look at how things have performed.
Right. So I would say it surprises me to see technology as the worst performer out of the different asset classes we looked at. But we have been talking about this, right? We didn't know when rates were going to start coming down, but we knew we were probably closer to rates coming down than rates moving up any further. Right. But what we're looking at here is a few themes that we've been talking about. The tailwind for longer term fixed income when rates start to come down, the tailwind for small cap companies when rates come down, even the slight tailwind for international equity when rates start to come down. And we looked at, how returns have unfolded since that point. And those tailwinds have been pushing, long-term fixed income higher. small cap higher, leading the way both at over a 5% return since that. They're beating those hot technology stocks by over 500 basis points since that point. Now,
Right.
there are a lot of cross currents, right? So we're not saying that this trend needs to continue, but we are saying that tailwind will likely remain there as rates come down. And what do we mean by that, right? Yields coming down pushes longer term fixed income prices up because you lock in those yields for longer, right? I would rather in a rate environment where rates are coming down, I'd rather own a 5-year U.S. Treasury than a 1-month U.S. Treasury, because when my 1-month U.S. Treasury matures, I need to buy another one. And if rates have come down, then I need to buy another 1-month U.S. Treasury at a lower rate, right? Whereas a 5-year, I could lock that in for longer. U.S. small cap, a lot of small cap companies have floating rate debt. So when rates came up, it put their bottom line under pressure. They had to pay out more, in terms of their debt service. When rates come down, that does the opposite effect, where they just become more profitable just because rates have come down and their bottom line can increase because of that.
Right. Even looking at international stocks, if our rates are coming down faster relative to other central banks around the world, that could weaken the dollar and be a tailwind for international stocks. So it's just surprising. July 4th, I'm sure at barbecues, everyone was talking about how well NVIDIA was performing. And, then you enter one little data point in July and it gets flipped on its head.
Right. Speaking of NVIDIA, let's jump into our next slide here, where we looked at, it's kind of a similar way of showing what we showed to some extent on the last slide, but we specifically targeted the Mag 7.
Right. So the Magnificent Seven stocks, if you've flipped on CNBC in the last year, you've heard of them, but it includes Apple, Google or Alphabet, Microsoft, Amazon, Facebook, or now Meta, and then Tesla and NVIDIA. And we just wanted to look at, the overall market since that July 11th date through, mid-October when we put these slide decks together, was doing well, right? The market, large cap US stocks were up 4.1% over this time period. If you break that out and say, well, what did just the Magnificent Seven do? And what did the other 493 stocks do? This paints a different picture. So we just looked at tech stocks being basically flat, a little bit down on the last slide. The Magnificent Seven did even worse than tech stocks. Now, not all of the Mag 7 stocks are technology companies, right? Amazon's consumer good, Facebook is communication services, Google's communication services, et cetera. But we wanted to look at these, magnificent growth companies and look at the rest of the economic basket, the other 493. And what you can see is the rally really broadened out. Maybe this was a rotational trade and things are going to continue on as they were. We'd probably guess that's not the case. I mean, these big companies have fantastic profit margins. They've done very well in the past. They're probably going to lead the charge, to some extent going forward, but more so from a broadening out perspective. This is a really healthy thing to see. It suggests the economy on a broad level is doing well. If, utilities, industrials, banks are all performing well in lockstep as rates are coming down. So it's nice to see this sort of rotation take place, but at the same time, it should be a positive tailwind for economic growth if not just 7 companies are leading the charge and making up, 80+% of returns like they did in 2023.
Right. So let's jump to the next slide, which I think is a bit of a reflection on our human behavior and how behaviorally we want to always avoid pain. We want to stick with the guarantees, right? We're more likely to gravitate towards those options than towards, what, may be what's better for us, so to speak, right? So, for those investors who had cash on the sidelines, who didn't need to have cash on the sidelines, it represented excess cash for them. And maybe they were waiting to put new money into the market. Or maybe they had X amount of equity exposure and they lowered that to put into cash just because cash was yielding 4 or 5%. So we heard a lot back in 2022, even the beginning of 2023. Why would I put my money in stocks when I can get a guaranteed 4 or 5% return from
Right.
cash? Well, we looked at it and we said, all right, well, when the 3-month T-bill, which is a common proxy for cash, that yield exceeded 4%, how have returns been when we look at stocks versus cash? And if you look at the blue line, right, that is the global stock market. That was up over 50% since that point. If you look at what you would have gotten from cash, that is up slightly over 10%. So there was an over 40% dispersion in returns, right, by sticking in cash, sticking with that guaranteed, and foregoing the return potential of stocks. And this is something we talked about a lot on the podcast Amplified Wealth, on why we shouldn't just default to cash, even though it's guaranteed and it's 4% or 5% at the time, depending on when we were talking about it. And that power of the stock market's returns, especially in the environment we were coming out of and coming into.
Right. I think it's important to put context around this argument. I'm not, I don't think either of us are saying that go out and deplete your cash hoard and your emergency savings and everything like that in your business or your personal life as soon as rates hit 3 or 4% or 5%. That's not what we're saying. We're saying if you were complacent with your excess cash, money that probably should have been invested for longer term prospects, not money you needed for a house in a year or anything like that, but longer term excess cash, if you were complacent because rates were at 4% and it felt a lot good relative to the last decade where savings accounts were yielding nothing, you missed out on a lot. That's a huge opportunity cost of 40%. Even if you had invested that more conservatively in bonds, it's 35+% opportunity cost. So I think context is important around ensuring that you have saved what you needed liquid and what you need saved. Anything else should have a longer term time horizon, longer term growth prospects, and you should be willing to take on that risk.
Right. And that's where a wealth plan comes into place, where you could project your wealth out forward over hundreds and hundreds of times of scenarios. And it can help you determine which allocation, how much do you need in stocks, bonds, cash, alternatives, gives you the highest probability of meeting your goals and not running out of money. So, right. Adam, we're looking at the past here and we're saying, yeah, we should have been in stocks, right? But what about now? What do you do now that the market's at all-time highs?
It's a great question. I mean, it's very common for people to want to wait for a correction, right? But data suggests actually that investing at the all-time high is something that presents good returns looking forward on average. It's typical that you see more all-time highs in clusters and throughout time, right? If you think about all through the 90s, all through the 2010s bull market, decades before that, they tend to come in droves. And it's a positive underlying current within the economy that's suggesting strength should continue for some time into the future. So all-time highs, the market's going to go even higher at some point. I don't know if it's tomorrow. I don't know if it's next year. I don't know if it's in 10 years, but the market will be higher long into the future than it is today. So just being scared because of a price level is nominally high. The S&P 500 is 5,800 today, 5,700 today. It's election day. There's a lot of nerves out there. People, that shouldn't shake you out just because we're at a very high number. The market's going to go higher eventually. It's just a matter of when.
Right. And I just want to emphasize that research that you pointed out that we have talked about on our quarterly market updates and the podcast, that we looked at, well, what if you only invested at all-time highs versus what if you just invest any day regardless? And what that research told us is historically you actually would have performed better over a 1 year, 2 year, 5 year, 10 year period by investing at the all-time high than at any other day. So,
right.
While investing at all-time high doesn't bring much comfort for a lot of people, there should be some comfort in knowing that if you were to follow that rule of thumb, if you were to just be okay, regardless of the market environment, just in investing at that all-time high, you actually would have made out pretty well.
Yeah, I mean, that's not a knock against dollar cost averaging or investing when the market's down, right? But you just need to recognize that the market is telling us something. When the market says we're at all-time highs, unless it's hype and euphoria, uh, the market is suggesting that future earnings are going to be more valuable than they are today, right? And we know that the economy is still growing. Corporate profits are at record highs, expected to grow over the next 10, 12 months. Um, these companies are making real money. It's not the tech bubble of the 1990s, 2000. We're not in that situation today.
Right. And let's also not look past the fact that, yes, when we look back over the last 12 months, the U.S. market has been up over 40% over the last 12 months. But when we look back over the last 3 years, the annualized return for the market is just under 10%, which is just about average, right? So, if that 3-year annualized return was, 30+%, yeah, maybe that's a cause to take another look. But, with the returns that we had in 2022, with that 2022 drawdown, it's not unusual to see a year or two of catch up before we revert back to, maybe a more normalized pattern of returns.
Right. I think if you see I think the stat there that you're referencing is basically if you see a double in the market over a 3-year period, that tends to represent historically when the market has topped out and gone too far and overextended itself. So the fact that we just have simply average returns over the last 3 years, in my eyes, that's a pretty positive viewpoint to be looking at if I'm a potential investor with cash on the sidelines today.
Right. It can be an indication of a bubble when that happens over a 3-year period.
Correct.
Now,
we're not there yet, to be clear.
Yeah. Speaking of indicators, and to just further the trust issues of our listeners, let's jump into the inversion of the yield curve, because the yield curve inverted, right? And you heard a lot of people in the media screaming that means a recession's on the way. That means we should be cautious with our stocks, raise cash, etc. So we looked at it, right? Can you tell us a little bit about what we found out?
Yeah. What's the famous quote about yield curve inversions? Something like, 15 out of the last 10 recessions have been preceded by a yield curve inversion. I'm butchering it, but the point is the yield curve inverts a lot, and we don't always have recessions from it. It can lead to one. Based on certain other economic factors, because the yield curve, which for those unfamiliar, what we're talking about here is just looking at different yields of different durations. When you have a lower short-term yield and a higher longer-term yield, that's normal. That's what you would expect. If you're going to loan someone money for a longer period of time, you expect that there's more risk tied to that loan, and you should get a higher interest rate. What we saw last year was short-term rates were higher than long-term rates. And that kind of made sense because of where inflation expectations were, right? The Fed was going to be raising rates on the short end to combat inflation, and longer-term growth and inflation expectations were not as high as where the Fed had rates. So that's what presented a inverted yield curve. And that's typically negative for loan growth and other business activity from the banking world standpoint. So that's why you sometimes see recessions post inversions of the yield curve. But at any rate, we wanted to look at, okay, well, what if we invested at stocks at this time versus holding cash and being a normal bond investor, and use this sole indicator as a way to get in and out of the market. And you would have realized that a similar story to the last slide, that there was a lot of opportunity cost if you had been out of the market during the time frame where the yield curve was inverted. So I think it stresses the point here of looking at more than just one indicator when you paint a picture. That's something we do for our clients. We want to factor in a lot of these different data points, but looking at just one simple thing and trying to draw a conclusion from that might be a futile exercise.
Right. And it's a lot harder to play catch up, right? If you miss out on a 20+% return, right? In order to catch up to the returns of the overall market, you would need to somehow leverage your returns going forward. You need to be taking on excess risk in order to catch up to the returns that you missed out on. Now, for most investors, they do have some sort of bond allocation. They're not just stocks, or they do have some cash on the sideline. It is a lot easier when the market draws back to then put more money into the market at lows, right? So you experience that drawdown to some extent. You put more money into the stock market now at lower prices, and then you could ride the market up. So the way you can recover by being in the market, right, is by adding more to it when the market starts trading at more attractive valuations relative to your target asset allocation. So it's a lot easier to correct a mistake staying long and experiencing the drawdown and then adding more and then letting it ride back up and then adding more to your bond and then rebalancing back to your bond allocation than it is to miss out on the stock market going up 20+%, because your options really are to take excessive risk. And a lot of clients just aren't in a position to want to do that.
I think it's worth noting, right when the yield curve did invert, you got an opportunity to create a spread in the other direction where holding cash would have been profitable. But you can see it was really just a couple of months before you would have been behind the eight ball again, right? So from the end of July through early October of 22, when the market bottomed, theoretically holding cash for those 2 months would have been the right move, but that's not counting in any sort of taxable gains, consequences from that perspective. And also from a psychological and emotional standpoint, I mean, we could rewind back to that day. Everyone was plastering it all over the news that we were headed for recession. And sure enough, we didn't. Right. So if you sell and the market drops 10%, I can almost guarantee you're going to be much less likely to put that money back into stocks at lower prices when everyone else in the market is panicking. Right. And then just as quickly, 2 weeks later, the market's back to equal with where it would have been for cash. So you missed your shot there. Getting out's not the hard part. It's getting back in. So this is something we practice and preach every day with our clients, is sticking towards those long-term goals with the money that deserves to be there, understanding what your core capital buckets are, what you need to keep on hand, what you can afford to have tied to more risk and longer term growth, because clearly in any sort of market environment over a long period of time, stocks are going to perform better typically than cash and bonds will.
Right. And we have a lot of different clients that view the markets very differently, right? Who have much larger or much smaller capital bases relative to their spending needs or their eventual spending needs. So we do have strategies and thought processes for all types of clients, right? There are clients where, it's just better off to pull back on that equity exposure in times of risk, because we know that if the market does drop a lot, they are going to be in a panic mode and they're going to want to take everything out, right? So our goal is to keep our clients as close to fully invested to their target allocation as possible at all times. And sometimes that does mean taking some risk off the table, right? And managing around that, because, our emotions can be very, very powerful, right? And they can overtake us. So, we have strategies for all different types of investors. And then, looking at the last two slides, when do I get my money in? Are we at all-time highs? We talked about investing at all-time highs. It's also important to know that there are strategies that play kind of both sides, where you could slowly get into the market, right? And in fact, there's a strategy where the market will actually pay you to say, I'll get in when the market drops 10 to 15%, right? And you get paid to wait. And then when the market does correct, you go in like, you may want to, right? So, and that's just one of many. There are many strategies out there where you could softly, slowly start to get in and warm up to that.
Yeah.
Okay.
Well, this has been a good chat. I know we mentioned it a couple times, but for those viewers, listeners, if you want to get more content from our team, we do have a podcast, Amplified Wealth. You can find that on Apple Music, Spotify, YouTube as well. Anywhere where you listen or want to watch to see accompanying charts of our current thoughts. There's a release a couple times a month, typically, Austin. Is that right?
Yep. Yep. And definitely, I'll say it now because I know we're running out of time. Scan the barcode. That brings you to the YouTube channel. But we're also on all of the, your favorite podcast apps. Just search for Amplified Wealth. You'll find us. We've interviewed the director of fixed income on municipal bonds from BlackRock. We've interviewed the Michael Townsend, who is Charles and Schwab and Companies, the guy on the street in Wall Street, not in Wall Street, sorry, in Washington, talking to the politicians. We did that leading up to the election. So a lot of cool interviews with interesting people, as well as great insights for managing your money over the long term.
So thank you again, everyone, for listening, watching, and we hope to see you next year.
Great. Thank you.